Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, president of Universal Accounting Center, and it's my pleasure to be with you today to help you as owners of bookkeeping, accounting, and tax businesses work on your business and, in fact, get the clients you deserve. Now, one of the things that I'd like to point out is each and every week we have on the show excellent guests, individuals that are experts in their own right that actually help us focus on what matters so that we can, in fact, offer quality services and get paid what we're worth. So in order to do that, today I have on the show Blake Oliver. Blake is someone I'm sure many of you are aware of. He is a CPA and accountant, podcaster, entrepreneur who specializes in financial technology. Blake is the creator of Earmark CPE. He actually has an app for you to go get NASBA-approved CPE by listening to your favorite accounting and tax podcasts, one of which happens to be some of our episodes. He also co-hosts the Accounting Podcast, the most popular podcast for accountants and bookkeepers in the world. And that's not a light claim. And with that, Blake lives in Scottsdale, Arizona, where he likes to hike in the Sonoran Preserve and play his cello, no less. So we're going to have to bring up the cello at some point. So Blake, welcome to the show.
Roger, it is an honor to be here. And I want to say that episode that you guested on my show, the Accounting Podcast, is the most popular episode we've ever had.
Holy cow.
Yeah, you broke the record.
Bam.
Yeah.
That is awesome. I didn't realize that. So thank you for telling me that. I had a lot of fun on the show. It was a good discussion. I like the fact that we brought up boxing or jujitsu for no less. I mean, that was an off-topic thing.
Yeah. And I think what really drove people in was pricing. We were talking a lot about how accountants should price a tax return. And that's a big point of contention. We've got people pricing them for like $200 for a business return. And we've got people doing $2,000 for a business return. So there's like this huge spread. And there's a lot of confusion in the market. And I don't know, you brought some clarity to that. So it's a great episode. Everyone should go listen to it.
Thank you. I appreciate it. Yeah, I remember in that we were talking about how you and David had bundled, I believe, the return and paid different for your individual ones outside of it. And yet there was this offer to bundle it that we were discussing. So yeah, there was a lot of conversation about that.
It's a good one.
Yep. All right. So this is what I'd like to do with you today. I'd like a little bit of a backstory, first of all, just an introduction, how you got into the accounting space, what brought you to becoming a CPA. And we're going to set the stage for a few of the conversation points we're going to have about your firm and the podcast itself. So give us a little bit of a background on you.
I'm a career changer. I didn't go into school thinking I wanted to be an accountant. I was a music major, and I graduated from Northwestern University with a degree in cello performance. And I moved to LA. I'm from California, from Sacramento.
Okay.
I moved to LA so I could work in the music scene in Los Angeles, try to break into film and TV recordings, be one of those cellists in the studio, recording Jurassic Park, right? That sort of thing. Indiana Jones, right? That's what I grew up with. And unfortunately, I had some pretty poor timing because the year I moved to LA was the year of the financial crisis. And all the budgets for all the studios got cut. And anyone who works in film finance or accounting knows that the first thing to get cut is the last thing in the production cycle, which is the music. So budgets are being cut. Live musicians are not so popular anymore. And we were getting automated. This was when the technology for synthesized strings became really, really good. So you could just sit there as a composer with a keyboard and you could play the sound of an orchestra. So all the live music started to go away and computers took over. And I saw that happening. And so within a year I said, all right, this career choice is not for me.
Yeah.
I got to figure something else out. And I got some work just like as a bookkeeper. Like I'm good with tech. I can do QuickBooks. I got a job entering checks into QuickBooks. And I had nothing else to do except, enter these checks and sort of read the QuickBooks manual. And I figured out there was all this amazing stuff you could do with it. I helped the business I was at really implement it beyond just being a check register. And that's how I fell in love with accounting tech and went back to school, became a CPA. That was the journey.
So I'm curious, some of the people that I speak to that have that kind of a journey where they transition and so forth, they don't become CPAs, they become bookkeepers, they become accountants, they may go get training, certifications, degrees. Why all the way to the CPA level?
It's a good question. I think it's because that's all I was aware of at the time in terms of you want to get to the top of the accounting field. What do? You go get your CPA, right?
That's fair.
So the programs that I enrolled in were designed to help you get the credits to sit for the CPA exam.
Yeah.
So I just went on that path by default. Of course, during that whole journey, I built a firm. I got into all this tech stuff, and I learned there's other paths available. But yeah, at that time, I didn't know. And I also felt like the CPA is a really strong brand. And that actually has proven out to be true, that when you have CPA at the end of your name, people pay attention.
Valid.
And they listen to you. They respect you. It helped me a lot as I was building my firm. And as a career changer, I felt like that was really important.
Well, you strike me as someone who excels in the sense that you're not just a celloist. You were obviously going to be very good and be in the orchestra. So to settle beyond, not becoming a CPA, that doesn't surprise me. You were going to go to the top, and that is the pinnacle of the accounting profession. So I understand that.
Yeah, it's sort of like it was there, right? So it was a challenge that I had to pursue for myself.
Very good. Okay, so you become a CPA.
Yeah.
And I based on your comment a moment ago, you might have had your practice by then, but I want to get the timing right. So did you become a CPA and then start your practice at some point, or did you actually go into business while you were in that process of getting your studies? How did that timeline play out?
So I looked into doing a master's program, and I did the math on it. And I realized it was going to be hard to work at the same time. So I was going to have opportunity cost if I did that. And it was going to be expensive just to take the courses. And a lot of people were going back to school because it was a recession. So it would be hard to get the classes I needed. So I decided I'm just going to get the credits from wherever I can, piece those together, and then sit for the CPA, because you don't actually have to get a master's to become a CPA. You just need the extra 30 credit hours and all these specific courses in accounting. So I did that with a combination of online courses and community college courses. And I did that over about 4 or 5 years, taking a couple at a time. And then as I was doing that, I was working as a freelance bookkeeper, and, I was doing well. And eventually I hired a bookkeeper, and then I hired another one. And within about 5 years, as I was doing night school, I had a firm that was approaching about $1 million in revenue. And we were 12 of us. And I had a CPA firm come along and say, hey, you want to merge in with us? And so I took that opportunity. And that was how my firm got acquired.
Okay, so this is fascinating to me. So when you were getting acquired, what do you think that they appreciated or valued that your firm was offering? Was it the client list that you had? Was it the employee base where you had this core group of individuals that you were working with? Was it the systems and processes that you had established to take care of the clients? What was the draw, and how would you talk about each of those 3 elements?
Yeah, it was a lot of that. I would say it was a combination of our technology stack, and it was our whole workflow, the way that we packaged and sold our services and delivered those on a monthly basis. We were doing fixed fee, subscription-based bookkeeping, bill pay, and payroll. Those were our 3 core services for small businesses. Variety. It was pretty simple. We didn't have like a particular niche. We just served maybe a particular size of business, right?
Okay.
These businesses that didn't have enough resources for any full-time employees, and they needed a fractional bookkeeper. There's a lot of firms doing that now, but when we started, I was, one of a few firms that were offering this sort of thing, and we could work with anyone, anywhere. We were fully remote. We didn't have an office. We had clients all over the country, all over the world. We were operating more like a tech company than an accounting firm. And that wasn't because I was like, I don't claim to be a genius about this sort of thing. I just was a career changer, and I didn't know how a traditional firm's supposed to operate. So I just looked at, how do technology companies do this? I looked at websites. I looked at what firms were doing in New Zealand and Australia. And I saw that there was this great way to productize services and sell them for, here, we're going to do your bookkeeping for $500 a month kind of thing. And so I did that. And that's what the market wanted. So, I credit actually my own ignorance with my success, is because I'd never grown up in this hourly billing mindset.
Yeah.
I got away from it as fast as I could because I didn't like it. And yeah.
That is awesome. So I'm curious about the staff that you had, these individuals that you were hiring that were bookkeepers, accountants. Were they more seasoned than you because you were still in the schooling process? Were they like you, also going along in their career path with schooling as well? What was that dynamic like? Were you hiring older, more seasoned people?
Yeah.
What was happening there?
It was kind of a mix. Okay. I would say the some younger folks, but actually mostly like women in their mid-career who wanted the flexibility to work from home. And that might be because they had families that they needed to take care of and they didn't want to commute. And traditional firms didn't treat them well and didn't give them flexibility. And I was willing to offer both.
Yeah.
And it was pretty simple. I think there's actually still a lot of people like that out there.
Yeah.
And when firms complain about not having enough talent to hire, it's because they're not looking in the right places.
They're not flexible enough. Yeah.
Yeah.
So when the acquisition happened, did you stay on with the firm?
So we made a deal where I could choose to take a buyout or stay. So I could, if I stayed beyond 12 months, I'd get equity. And if I left before 12 months, I'd get a buyout over 4 or 5 years.
Yeah. And so, which did you end up getting?
After about 8 years, an opportunity kind of came along. You know, I felt like, you know what, I've been doing this for a while. I'm going to try something else. So I took the buyout.
Okay.
So basically I took the option to sell.
Yeah.
And I left. And that's when I started my journey into technology companies and all this other stuff.
Yeah.
I kind of regret it though. Like there's part of me
really,
because that firm then got acquired by a top 50 firm. So I'd be a partner over at a top 50 firm if I had stuck around. That would be pretty great.
That would be.
Maybe they would have made me take a buyout then. I don't know if they would have accepted me as a partner at that firm, but yeah.
Well, you know, woulda, coulda, shoulda, I guess.
Yeah. But you know, the other path I took was I went to work for technology companies. Mm-hmm. I got into marketing at tech, and like that taught me a whole bunch of stuff. And I consider that to have been like an MBA in itself, and was totally worth it. And you know, there's all stock options and potential future benefits that could be way bigger. I mean, you never, in hindsight, right? You never know.
Oh, of course.
But it's been a fun journey. Like I like to think that I if I could summarize my experience, I've sort of built a small firm. I've also worked in now a large firm, and I've worked at technology companies. And I think they all do something great, but they're all missing something too. And if you can learn from all three, you can be incredibly successful.
So where do you feel they're missing the mark? You say that there's something missing. What is it?
A lot of technology companies, where they fail is with the customer support.
Okay.
Right. And that's what accounting firms do really, really well, generally, compared to technology companies.
Okay.
We are really good at working with people. Large firms, especially, the consultative advisory type of work that they do is spectacular. And that's why they make the big bucks and can charge those high hourly rates. What the large firms do poorly is just the whole business model of billing high hourly rates instead of billing for outcomes, which is what the tech companies do.
Uh-huh.
Small firms, you know, they are agile. They can provide services to small businesses that large firms can't, but they tend to focus on doing the work, you know, the work that they are doing rather than, how do I describe it? It's they tend not to have the resources to focus on the bigger picture outcomes that like a large firm can. But they're agile and they can leverage the technology to deliver a better service than the large firms. So it's almost like a game of rock, paper, scissors.
And Are you involved in that process at all? As because you see it, are you able to engage and address it?
Well, what I'm trying to do is like use my experience on our show to offer insights from either all three sides, because I've been in all three environments. You know, so we look on our show, the accounting podcast, we look at the news in accounting every week, and we talk about the top stories and we analyze them. And I try to offer that perspective of somebody who's been in all of these different places. So I can look at what Intuit is doing with TurboTax live, and I can see both what they're doing well and what they're not doing well, and hopefully offer some insights to the small firms that have to now compete with that. And there's a lot that we can learn in small firms from what tech companies are doing that are now offering tax preparation and bookkeeping and advisory services.
Yeah.
And we can beat them.
Or at least engage and meet where they're not performing.
Exactly. Take the part of the market that they can't serve.
Yeah.
Yeah. Which is a lot. Yeah.
All right. So I'm going to back up here a little bit because there is something I do feel I need to ask. You eventually became the CPA. Did that change anything in your career? Did that was that a pivotal moment? Did it actually change anything trajectory-wise or how people perceived you? Or was it the capstone that you needed, but you've noticed later on it didn't really make a difference after the fact? What are your thoughts on that?
It was anticlimactic, to be honest, because it just took so long.
Yeah.
Taking all the classes, sending in my transcripts, taking the exams, then meeting the work experience requirement.
Yeah.
It just took forever. And by the time I actually got it, I didn't really need it anymore.
Yeah.
But I would say that having it has helped with credibility. It really does. It opens doors for you.
Very true.
I'm glad I did it.
Yeah.
But this is one of my criticisms of the whole accounting education and the CPA is that a lot of it is rooted in concepts that applied in an economy of the industrial age with a really heavy focus on cost accounting. Not that there's anything wrong with cost accounting, but I think we apply those theories to businesses where it's not appropriate, including our own firms.
Yeah.
And that old thinking is really what's holding back the profession in a lot of ways. And it kind of took me a long time. I guess it was the experience working at technology companies that made me realize just how outdated accounting theory and education can be in a traditional university setting.
Fascinating. So I have to ask about the testing. Was it pre what it is today, where you had that weekend of the exams, or did you take it when it was more flexible as it is now?
No, thank God it was during the electronic testing era.
All right.
Yeah, I went to Prometric centers and I could do one exam at a time.
Yeah, your perspective between the two would be relevant here because it has changed. I want to say recently, but it's been years now. So that's all perspective.
Yeah, I think it was, maybe it was like 10 years ago that it changed, something like that. Maybe a little, I was right. I was after that, yeah.
I mean, I was alive when the change happened. It's just I'm so old now. It's the context of when was that? I don't remember. All right. So what would you suggest change then? What should be different if we could magically wave this wand and add something or distract or detract something? What would it be?
Okay, so big picture.
Yeah, big picture.
Big picture. The problem with accounting theory and the way we think as accountants about capitalizing costs is sort of backwards from the way a lot of businesses operate these days, especially subscription businesses.
Okay.
And I had this revelation when I went to Flowcast. I left a large accounting firm as a manager to go work as a product marketer at a startup called Flowcast, which makes close management software. Corporate controllers buy the software to manage the financial close checklist for their companies. So we're talking, decent sized businesses that have a financial close checklist, that have, a dozen people working on the close that all need to be organized together.
Yeah.
So at Flowcast, we had a weekly all hands meeting where our CEO would go over the most important metrics for the company. He would put up our CAC, our cost to acquire customer, our LTV, our lifetime value. We would talk about CAC divided by, or LTV divided by CAC. We'd do all these SaaS metrics, and you can go search for those. And there's this whole world of metrics that are tracked in software and in subscription businesses.
And I use those. So this is good. Keep going.
Yeah. Well, I'd never learned any of that in my accounting classes because it's not part of GAAP.
Yeah.
The only financial ratio that exists in generally accepted accounting principles is earnings per share. Believe it or not, it's the only one. Everything else is not non-standard, right? There's no GAAP for it, and it made me realize that there's something wrong with accounting when all of these startups are using non-GAAP metrics to describe what they're doing. They're not looking at the traditional financial statements at all. We never, as a business, looked at the GAAP financials that our corporate controller and CFO were preparing.
Really?
Never.
Okay.
It meant nothing to us. And it was wrong, the way we looked at the business. And I've been thinking about this for years now. Why is this, right? Why is this? Well, you go back to the roots of modern accounting, and it was not that long ago. We're talking the late 1800s, when the massive railroad expansion was happening in the United States. We're building railroads all over the country.
Mm-hmm.
And the way we're financing this, the railroad barons are financing this, is with European money, old money in Europe. investing in railroads in the United States.
Okay.
And so all these investors in Europe wanted to know their money was being spent properly. So what did they do? They got a bunch of Scottish accountants to come over to the United States and keep tabs on things. And those folks became like the first accountants. They invented depreciation. They came up with this whole idea of let's capitalize all these assets and depreciate them over time and produce financial statements about railroads so that we can actually see, are they profitable or not? That was all developed then. And that business model is not what most businesses are now, which is, we don't have massive railroads that we're laying down and train cars that we're running around the country. We've got all these intangible assets.
Yeah.
Right? We're a knowledge economy now. And a subscription business, we don't go and manufacture a bunch of product and then take it to market and sell it. We get a bunch of subscribers and then we provide a bunch of services and software to them after we get them.
Yeah. Intellectual property.
Right. It's all, the order is changed and the accounting hasn't changed. Accounting is still really, really focused on tangible assets and capitalizing them and cost accounting based on manufacturing theory. And none of it applies to a subscription business. Most service businesses shouldn't use it. And that's why I think as accountants, we struggle to understand the power of the subscription economy.
So I'm going to jump in here because this is fascinating to me. And it's very relevant to the advisory services I provide to business clients and the conversations I have over there. And this is how it relates. The accounting is the language of business. We'll just start with that to say that when we're looking at the financial reports, as you've already mentioned, the P&L balance sheet, those are relevant in the conversations we may be having with the VC or with the lenders, the banks. It is an end as to kind of like a capstone of the bank of the financial experience of that business. But you're so right that the conversations I'm having with the business owner are more built around their cost per acquisition. It's their lifetime value. It's all these KPIs that are at the forefront of the business that are far more important and necessary to know to make business decisions than what those last reports are telling us. I find that they're very helpful and important, and I do leverage them. But you're so right to say that there are other leading and lagging indicators that I need to be watching in the business to make informed decisions. And those become so vital to the success of the company. And to educate a business owner as to what are those KPIs that they should be watching so often involve numbers that aren't on the financial reports.
Yeah.
They're numbers that are elsewhere. And that determines the vitality of the business, whether or not they're going to be making the right decisions with regards to their marketing and hiring and cost or their inventory. All those things are hinged on so many other numbers that are outside of this. Now, I say that because that's my experience, but I think it's kind of relevant to what you're describing here.
So can we do an example to make it real for people? Okay. So the simplest way to get your mind around this is think about sales and marketing expense.
Okay.
For a subscription business like Netflix.
All right.
So Netflix knows that they have an average subscription price. They know from internal data based on what it costs to advertise online, all that stuff, how much it costs them to acquire a customer. So anyway, they have a lifetime value, and let's say it's like $300 and their cost to acquire them is $20. That's actually really low. It probably is a lot higher. It's probably like $200 to acquire that customer.
That's what I was going to say. Yeah. It usually has some component of maybe, 5 times the initial investment. Yeah.
Right. So, but the idea is, whatever they spend to acquire that customer, they don't want it to be more than the cash they're going to bring in from that customer over the course of that customer's life. Right. Like you don't want to spend more than you're going to make.
Yeah.
From the customer.
So if the value of the client's $3,000 and it's that $20 increment that they're coming in, you don't want to spend more than the $3,000 you're ultimately going to get in the lifetime value of the client to acquire them. So there's got to be a margin in there.
But let's look at what happens on the set of financial statements when Netflix does this. Okay, so let's say, for simplicity, let's say the customer lifetime value is $100 and they spend $100 to acquire that customer. So if they get one customer, that means they're going to have, and let's say that it's split over 2 years. So they're going to get $50 in year one and $50 in year two. So on year one, they're going to have revenue of $50 and expense of $100, and they're going to show a loss of $50, according to GAAP. Now they're going to make up that $50 in year two. But like according to GAAP, they lost money on this. But according to subscription theory, they did not lose money. They broke even, right? And it gets worse when like that's actually a profitable thing. So let's say their lifetime value is, not $100. Let's say it's $200, and they spend $100 to acquire the customer. So in they're going to show they might show a loss in year one, but they know they've got this revenue stream coming in future years. So what I'm trying to say is, and I'm probably not doing a great job of it, is that because sales and marketing expense always has to be expensed and can't be capitalized, subscription businesses will always look bad on paper. Because if you have the cash to spend to acquire customers, and you're going to be profitable on those customers because of the lifetime value and the cost to acquire, right? You should just spend all your money on acquiring customers. You're building this annuity. But GAAP doesn't recognize that annuity on the balance sheet, right? You're spending all this sales and marketing money, and your revenue is less than that, and you're showing a loss. So this is why, like Amazon for years and years got pummeled on Wall Street, because they were building basically a subscription business with Prime, right? But all that revenue was out in future periods, but they weren't allowed to they weren't allowed to capitalize their marketing expense and show that properly. Does that make sense?
It does, because I think what my listeners need to understand is so many times I've had conversations with people that say, how does a business, a tech business, sell for billions of dollars when their balance sheet is showing that they're negative, when their P&L shows that they're negative?
Right. They're losing money. How can they be worth billions of dollars, right?
Exactly. And so it's hard for them to realize that a business losing money today, Facebook and all these others that were showing initially these losses, what they were banking on is exactly what you're describing, the lifetime value of the client. And they knew that as they were acquiring businesses, or acquiring clients rather, they were in a process of acquiring customer loyalty, brand acknowledgement, and all of a sudden this revenue is going to manifest itself down the line. And the purchasers knew this. And that was one of the valuation components, is this subscription model. They knew that Netflix subscribers are going to last, like you said at the beginning, 5 years. This number we pulled out of a hat. That 5-year period obviously is something of worth, and we're only in year 2. Well, yeah, year 2 we're showing a negative, but we've got 3 years worth of acquiring new clients and 3 years more of these initial clients finally paying off, and that's where the returns are going to come. So, your example, although difficult to describe, is very, very valid, that the accounting is lacking a way of explaining this predetermined valuation of a client that we can't put on the books anywhere because we haven't realized those payments yet.
Yeah, and maybe I can clear it up. So let's say we have a customer worth $1,000 over 10 years. So it's $100 year 1, $100 year 2, $100 year 3. If we spend $500 to acquire that customer, we're going to show this massive loss in year 1.
And
right?
2.
And we're going to, and especially if we're continuing to acquire customers, right? It's going to look like we are losing a lot of money.
And if you start to exponentially take on new customers, you could actually gobble up some of the revenue that starts to appear in years 2, 3, 4, because you're growing so exponentially fast that your cost per acquisition is so high and it's not being offset by the revenue that's coming down the line.
Exactly. And then you go out and you raise money because you're actually doubling your money. Every time you get a customer, if the metrics are right, you're going to double your money in the future.
Yes.
Right? But GAAP doesn't show that.
I'm loving this. This is good.
Yeah.
I think a lot of the listeners are probably familiar with this, and they struggle likewise to explain exactly what we're discussing.
Yeah. So this is why, if we're going to serve subscription businesses, and more businesses are converting to that, like my air conditioning company is now a subscription business. My termite, company now offers what they call a warranty. It's like an annual subscription, though.
And they'll come out quarterly, annually, spray. Yeah.
Our pest control is a subscription. Everything's a subscription now. And if you're doing accounting based on what you learned in school with cost accounting, it doesn't make sense. It won't look right.
And, here's something that's fascinating about this. And I don't know if I'm going to explain this well. Imagine if you're a young person starting a business and you're aware of these subscription principles and you start a company knowing you're going to show those initial losses. You're not worried about that. But imagine if you have a client that's older, and I say older just because as a stereotypical, the older people might be more prone to old business models, and you introduced to them this concept like you're describing of let's move our business to a subscription-based business. And here I am, I'm an older gentleman, I'm running a business for 20, 30 years, and you're suggesting I transition my business model to offer subscription services. Initially, I might become kind of paranoid when you as the accountant walk in and you're showing me that the money isn't there. The losses are being incurred, and I'm not able to see how this is rationally making sense. And all my accountant can say and all my sales consultants can say is trust the process. The subscription model will pay off. It is going to work. This is how everybody else does it. And as a business owner, I could see panic setting in because it's not appearing in the bank. I'm spending my advertising dollars to get a client that's paying a fraction of what my cost per acquisition is. And in that process, I'm going further and further into debt, or my savings are going less and less. And I'm all doing this in the hopes that the cost per acquisition is little enough that the lifetime value is going to offset it very quickly. How's that?
Yeah, that's great. And so we need to understand these concepts so we can explain and reconcile the difference in what we're required to report versus how the business actually works.
Yeah.
Because accounting that banks use has not caught up.
Yep. So we're not going to refer to this as a second set of books. We won't call it that, but we have to have some other way to visually show with a pro forma how this is playing out and how they should trust this business model process. Is that fair to say?
Yeah. And an easy way you can do it is to, in addition to your income statement and balance sheet, is to have a subscription statement.
Yeah.
Call it whatever you want. And one of the numbers you can put on there is the lifetime value of my subscribers. So you just take the total number of subscribers and you can calculate the lifetime value of those if you know your churn rate, if you know how many leave you every month or every year. And you can put that number, not on the balance sheet, but somewhere else in a note, and you adjust based on that.
Yeah. And then what the game becomes is that churn rate that you talked about, how fast they're leaving. You want to focus on what can you do to retain them. And the more you can decrease that number, hold them longer, extending the lifetime value, thus increasing it, that's your business model. The game becomes retention.
Yep. So for example, with Earmark, my retention right now is about 60%. So we've been operating now for a year.
Yeah.
And we've got our first overlap with subscriptions. They're starting to renew. We do an annual subscription. And so 60% of my subscriptions are renewing. That means if I take the $100 price we charge and I divide that by the churn rate, which is the inverse, which is 0.4, right? I get a lifetime customer value of about $250. So I know I should not spend more than $250 to get a subscriber, or I will lose money.
Plus your operating expenses.
Plus all the operating expenses. You got to take that into account. But
okay,
so software businesses have very low operating expenses, thankfully.
Yeah. So now you are focused on what can I do to lessen that churn rate?
Yeah. How can I get that up to or down to 10%? Because if my churn rate's 10%,
your lifetime value goes up.
Lifetime value is 10 times. It's $1,000.
Yeah.
Right. Because it's 100 divided by 0.1. So retention, we know this. If you this is something that's not new. We all know that it's better to keep a customer than to acquire a new one. This proves it with the math of the subscription businesses.
Yeah. So if you've got a customer that's not paying you, obviously that doesn't matter. But because of the subscription model, you're dependent upon that next payment. Can you provide enough value that they'll actually pay again and then again? And if you can extend that 1, 2, 3, 10 more payments, it really pays off exponentially. So this is perfect. All right. So you mentioned Earmark. I want to get to that. But to get to that, I think we need to back up a step. You and David started a podcast. Tell us about why a podcast? How did you get this idea of doing a podcast? And you talked about current events and talking about current cycles, but still, why a podcast? I can have a conversation with a buddy about current events all day long, but why a podcast?
It was 5 years ago. So I don't actually remember exactly why, if I had a reason other than ego or just wanting to have a podcast. I had a newsletter. I had a weekly newsletter that I sent out to 1,000 people about all the latest technology and accounting stuff. And I said, well, why not do a live version of this? Why not record this and talk about it? And so that's how the podcast was born. And eventually it just became easier to do the podcast than to do the newsletter, right? It's a lot easier just to have a weekly recording time, get on and talk.
Exactly.
And especially when you got someone to talk to about. So like we're talking, Roger, this is fun. I love doing this kind of thing. So yeah, that's how it was born.
The two of you have a great dynamic that I think is very insightful. You're each able to talk on the topics and contribute. So I think that's fascinating. Yep. You were kind enough to invite me into that dialogue, and I was able to contribute, and that was nice. So give the listeners, my listeners, an understanding of what your podcast is doing with the accounting podcast.
Yeah. So every week I get on with my co-host, David Leary. He comes from Intuit. He spent 20 years at Intuit. I come from accounting, having owned a firm and worked in firms. So we each have that perspective. And we come to the show having read all the news stories on all the accounting sites and the Wall Street Journal and Fortune and whatever. We read the news, and then we just share what is top of mind for us. What is the most interesting news that happened that week in accounting? And we analyze it. And we do that for an hour every week. And you can earn CPE for it with the Earmark app. And that's how Earmark was born, is our listeners started saying, hey, I learned so much from your podcast. How could I get CPE for it? Yeah. Almost as a joke. Like, I should get CPE for this. And so I set out to figure out how could we actually do that, add self-study CPE to every episode. So we created a mobile app. It's kind of like a podcast player, but works for CPE as well. So you listen to the episode, take a quiz, email your CPE certificate to yourself.
So you did a nice segue into that. That transition wasn't very easy. Getting NASBA to agree with you and offer this ability, that was a feat to be had, right?
Well, I'm a CPA, and one of the things that I like doing that helps with being a CPA is reading the rules and figuring out how to take advantage of those rules. That's what we do in tax, right? We look for the loopholes. We look for the benefits for our clients. How can we take full advantage of this? So I read the NASBA rulebook. They call it their standards. Yeah. And it's about 60 something pages. Read all the relevant sections about self-study CPE. They have different types. And I figured out, we can automate all of this with an app. So we don't have to do live polling questions. We don't have to send you something in the mail and you fill it out and send it back, and then a human being looks at it. Like, nothing in the rules says we can't automate this with technology. So that's what we did.
I love it. And I appreciate you doing that. I'm sure a lot of the CPAs appreciate the CPE element of it. I, as a podcaster, appreciate the fact that you provide this platform, because some of the episodes are on your Earmark service. And let me just say, from my perspective, it's not as easy as it sounds to get one of them on there. It takes a little bit of effort. So there is a qualification. There is a way of vetting. It's not just entertainment. There is educational components to this, and it is valid CPE. So I appreciate that. And I like the fact that I'm actually able to contribute. So thank you for that opportunity. That's very important to me, in fact. So thank you.
Yeah, the quizzes are actually kind of challenging. Like, you really have to listen to an episode to answer those 5 quiz questions and get 4 out of 5 right. And so we don't mess around with that. We have a CPA who reviews all of the courses to make sure they're compliant. It's legit. I should also mention, you can get IRS continuing education with our app too. So if there's enrolled agents listening,
EAs,
you can get that. And not every course qualifies, because the IRS only gives credit for federal tax and ethics. So it's a subset of courses, but you can go on and you can find tons of them.
Beautiful, beautiful. I love this. And regarding the questions, to come up with the questions for the episode, it's not an easy feat. I mean, you do require that they are actual questions relative to the discussion, and there are no cheater question answers. So it takes a minute. In other words, to put an episode on the platform takes time on my part to actually put together the content as you expect it, so that it can actually be a valid show. So my point is to simply say, it's not a flippant little process that is, cheating the system. It's a valid process where the content is relevant. So thank you.
I believe that people who use Earmark are actually learning more than people who use these cheap online all-you-can-eat CPE providers, where, just put up a video on the screen, do other stuff, and then, answer questions every now and then. Like, nobody's learning anything doing that.
The polling questions that come live, just click so that you can show you're participating. Yeah.
You're going to learn a lot more if you're like jogging and you're listening to a podcast and you've got your attention there, right? You're not working at the same time. I mean, I go to conferences and I see people who are there for the CPE, like with their computers open, doing work during the session.
Yes.
Like they're not learning anything. Yeah. So I think we actually are helping to raise the quality, and CPE should be more than just a checkbox that you check.
Very good.
So, and it's free. Good. I should mention it's free, right? So you're getting high quality CPE and it's free.
Yeah. No, love it. This is awesome. Okay. So let me ask a few business related questions, because I think that this is something that you have some insight on. The first is how does an accountant increase revenue per client? So, you talk about value bundling, the different services, bookkeeping, tax. So how does that happen? And related to this is this whole idea that we're now starting to hear the term CAS, a CAS offering. What does CAS stand for? What's that acronym? And what can you say about this whole bundling offer?
Yeah, well, answering your first question, in software companies, expansion revenue is a big deal. Expansion means you get the customer in for a particular service or product they need, and then you sell a bunch of other stuff to them. And this is how Intuit became a multi-billion-dollar company, is people would buy QuickBooks for $50 a month or whatever, and then they would buy the payroll, they'd buy the merchant processing, they'd buy the blah, blah, blah. And pretty soon, the average customer is paying hundreds of dollars a month. So accounting firms can do exactly the same thing. And we've historically done that by sending the client an engagement letter that lets us start on an hourly basis. And then our hours just gradually increase as we offer more and more value. Nothing wrong with that, but you're much better off if you're doing the fixed fee bundled services. So, get the client in the door on a fixed fee for, say, bookkeeping work, and then you can start sending them little nuggets of advice. And soon they want to sign up for your virtual CFO services. Get them in on that, right? Oh, you lost your clerk or your office manager who used to pay the bills. We can pay your bills. Oh yeah, you don't want to run payroll yourself anymore? Yeah, we can process that payroll for you. So that's how you grow a firm. Get the client in the door with a compelling offer, and then add on more services.
Yeah, I talk about this a lot in a book that I just published regarding your strategic accountant. And it's that strategy, like you're sharing there. It's understanding that there's 6 elements to the accounting process. And as you basically interact with the client, you can move along and incorporate each of these elements one by one into the bundle that you're providing as a service offering. So yeah, I like that. That's very good. So talk about CAS then.
Well, before I do that, can I just share one thing that worked really well for us that you reminded me of?
Yeah.
So when I started, I was one of the few bookkeepers who assisted with Xero, XERO, competitor to QuickBooks. Uh-huh. And so I would get a ton of people filling out my contact form on my website, just looking for help setting up Xero. And I didn't really want that work because I wanted the ongoing work. But that was why people were contacting me. So we came up with a productized service where we would go into your Xero file and we would do a full assessment. We called it our Xero assessment. And so for like $500, we would go through this checklist, sort of like when you get your car checked out.
Yeah.
Kind of thing, right? And we charged you'd pay up front, pay the $500, give us access to your file. And then I developed the checklist. It was me doing it at first, but then I handed it off to one of my employees who could do these all day long. And we'd identify all the problems and then tell you about what those problems are and give you a starting point as to how to fix them. And then this was the kicker. At the end of that report, we'd say, here's what we think it would cost for us to do this for you. And guess what?
They don't want to do it.
A good chunk of people would say, actually, I would love to hire you to do this.
Yep.
So I have now gotten my clients to pay me to do an assessment that a lot of firms are doing for free. They would do all that work to figure out, what is the scope of services that this client needs. And we got them to pay us $500. So
that is beautiful.
That is the way I recommend getting clients in the door on a productized service basis rather than hourly.
Well, one of the things that I'd add to this is what you've done is you've positioned yourself as an expert. They come in presuming that there's no risk. I'm just going to go through, use this process, pay you to kind of check off, did I do everything right? The 72-point inspection like a car is.
Yep.
And then at the end, you're pointing out, well, here's these 12 things that are either undone, need to be done. And by the way, I can do this for you on a regular basis. And I've realized in the process of setting things up, that wasn't as fun or as easy as I thought it might be. And honestly, I'd rather be doing what I do for a living. So yeah, let me pay you, and why don't you take it on from here? So I like that.
Yeah, and the risk to them is, worst case scenario, they're out $500, right?
Yeah.
So it's like very little commitment for them.
Yeah.
And whatever, if 500 is too low for you, don't think about the price. The point is like how it's structured, right? It could be $5,000. Exactly. Like it just depends on who your customer is.
Yeah, the concept is what matters there.
Yeah.
Good. All right, Cass.
Client accounting services.
Yeah.
I just like to call it accounting because I think we're returning to our roots as accountants, actually doing accounting, like doing the books. We've gotten out of that too much, like tax, audit, great services and everything, but accounting firms, we're called accounting firms.
Yeah.
So we should do accounting. That's what client accounting services is. I did bookkeeping, bill pay, and payroll as my core services. So we would do that on an outsourced basis. But it can include anything that normally an in-house accountant or bookkeeper or controller would be doing. I mean, even a CFO, you could have CFO advisory services inside of that if you wanted to. So I think it's the best place to be as an accounting firm. In the past few years, it's surpassed 10% of firm revenues, like for all accounting firms or CPA firms anyway. And it's just growing super fast. Like it's a recurring revenue business. The multiples on firms that do CAS are greater than 1, can approach 2 or even 3 if it's done right. It's a great business because you can build that as a firm owner and get yourself out of almost all of the service delivery. So you can actually build a business that you're not working in all the time. And I have a friend, my friend Scott, I just interviewed him. He's got a firm in North Carolina. It's a Paget practice.
Okay.
He's getting close to like $2 million a year in revenue. He's going to pull in 20% of that. So $400,000 as the owner. He puts maybe an hour or 2 of work into that firm every week.
Wow. That's impressive.
And it's all client accounting services and tax work. They
bundle it. And it's
it.
probably something he's systematized, which is why he's only in there so little.
Yeah, exactly. Like he hires people who can do the bookkeeping and deliver it and do quality control and do a tax return. And, it's not complicated stuff where even if it is, he doesn't have to be in it.
Yeah.
He can make a process so that other people can do it.
I love it.
And that's the kind of businesses that get me really excited. Because what's the point of making $1 million a year as a CPA if you never see your family and you never take a vacation? Like, I don't see the point.
I've got 3 more questions. Next one is this. Growing the business as you did, as you described that growth, what does a CPA need to do to kind of free up their time so that they can actually dedicate time to marketing? I think we get kind of sucked into what we're familiar with, what we like, what we're good at, and we neglect the growth of the business, finding the time to market. Do you have any suggestions on that?
So if you're too busy and you've got too much work, it's never going to happen. So the first thing you have to do is the hardest thing, which is you have to give up the work. You've got to make time in your schedule. And I think a lot of times we don't make enough. Like you can't just do marketing for like half a day every week and have it be effective. Even a day, I don't know if that's enough, like to focus on that kind of thinking. I would think you got to make a drastic change to figure out, how do I cut half of the work I'm doing? If I'm doing 40 hours a week, how do I get it done to 20? And then you really have breathing room because you can spend half your day every day working on growing the business, not being in it. And you could take a pay cut. That's one way to do it, right? Hire somebody to do the work and take a pay cut, raise your rates. A lot of firms aren't charging enough. It's painful and you might feel bad about it, but there's a lot of room to do that, right? You can raise your rates, lose some clients, keep the same revenue. All sorts of ways. I'm sure you talk about that, Roger.
Yeah.
You got to build the capacity so that you've got time every day to work on this. And so once you've made that time, then I think you can talk about like doing effective sales and marketing and really growing your firm. And there's lots and lots of things you can do. But if you're just too busy, it's never going to happen.
Well, I love the fact that you're saying you've got to find the time. So what can you either delegate, disconnect, outsource that frees up your time? Because client acquisition, especially if you're the owner, is the priority that you've got to be focusing on is growth.
So it depends on what you're doing, but it's basically processing the services that you're doing and figuring out, if you're doing tax returns, like, how can I build a process where I don't have to be involved in preparing these tax returns or even reviewing them? And that means creating checklists and a quality control system so that you can rest assured that these returns are being prepared with a reasonable degree of accuracy and delivered with a reasonable degree of accuracy after review. And I think for a lot of accountants, we have unreasonable expectations as to quality. Everything has to be 100% tied out to the penny. And you just have to accept that when you hire employees and you delegate, it's not going to happen. So you got to say, what is acceptable? What kind of mistakes are okay and what are not? And just like any company, like, no company offers perfect service. So letting go and being okay with mistakes happening and delegating and all of that. That's why it's actually great, like, to not, like, the most successful firm owners are often not the best accountants, because they can hire other people to do it better than them.
That's right. Yeah. When I talk to people that are franchise owners, think of it. Just because you own a McDonald's franchise doesn't mean you know how to fry the French fries. I mean, granted, you go to Mick University and probably learned it, but when was the last time the owner got in there and literally fried the French fries, right?
Another successful firm owner I know here in the Phoenix area, Michael Lee, owns a firm called Reconciled. He doesn't know a thing about taxes, and they do a ton of tax.
Yeah.
He built a tax firm without knowing anything about taxes, and he never got sucked into doing the work because he didn't know how.
Yeah, right? Exactly.
So I think that's part of the problem, is that, like, when you've been providing the service all those years, like, it's really hard to let go.
Well, what you're describing there are some of the conversations I have with firm owners where they feel in order to expand and offer a new service, they have to be able to do the service they're offering. When in reality, they can see a need that the client has. They can hire someone, like in the case of you're offering bookkeeping services, I want to hire some tax specialists. Now you can make revenue off of the clients that you have offering tax services, but yet you're not the tax provider. Yeah. It's the person you hired that's the tax specialist that's doing that. So yeah, it's a great opportunity to grow the company and not get sucked into the day-to-day operations of it.
So if you're a tax firm, add client accounting services and bring in somebody who can manage that for you. Give them a piece of the action, incentivize them, and I'm sure you have lots of clients that need this work, and it's just untapped revenue.
Yep.
And likewise, right? If you're doing bookkeeping, your clients need tax work. Bring in a tax pro, build out processes so that they can work effectively, and you can monitor.
Yeah, be a business owner. That's what you've got to do. Put that mindset on.
But I think you really got to think: is that what you really want?
Correct.
I think there's a lot of pressure to, like, be a firm owner, and if that's not the work you enjoy, if you actually really enjoy doing the accounting work or doing the tax work, just be happy doing that. Because being a business owner is not being a service provider or being an advisor. Once you actually scale it up, it's HR, it's legal, it's tech. It's dealing with all the crap that most service providers or advisors want to have nothing to do with. And this is why most medical practices these days are not run by doctors. They're run by professional administrators, because the jobs are completely different. And we're going there with, like, legal as well in a lot of cases.
You've made an excellent point. Just because you are offering these services as a solopreneur doesn't mean you have to grow a business. And it's a totally different skill set to run a firm. So you've got to assess what you're trying to do with your company, and nothing wrong with being a solopreneur, nothing wrong with only offering bookkeeping services, nothing wrong with any of those things. This is your company, but there are paths to do what it is you aspire to do if that's the inclination you have. Yeah. All right. So I've got two more questions. I'm going to throw an audible here and say, you like talking current events. I just literally before our conversation got an email from a group of people I'm familiar with, and they were talking about the central bank digital currencies, the CBDCs. Oh, yeah. And the conversation was, I don't know if you've been watching what's been happening, but currently in the news, there's a situation with Nigel Farage over in the UK where he's been unable to retain his bank accounts, basically because of his involvement with the Brexit. And so he had his banks had bank accounts for over a decade, and they kicked him out, and now he can't get banks. There's 10 banks that have turned him down. But likewise, there's a story that just came out where there is a business, it's Mercola. Basically, the bank accounts of the Mercola CEOs and their family have been kicked out of Chase. And Chase has basically said, we're not going to have you bank with us, your company, you yourselves, or your close relatives. The kids and everybody else have lost their accounts. Any thoughts on any of this?
Well, I do believe that it is inevitable for the United States to have its own central bank digital currency.
Okay.
We will have an official Bitcoin, right, of the United States. Whether or not it ends up being that we take it over or create our own, remains to be seen.
Yeah.
But I do think it will happen, because currency is the primary way that a government controls the economy. And governments generally don't give up power once they have it. They hold on to it. And so crypto has not really presented a threat, because most crypto has just been a scam up to this point, right? It's not actually competing with the US dollar as a currency. I mean, can you go buy a sandwich at your local, corner store with crypto? No, you can't buy anything with it other than drugs, right? And, some applications of, exchanging money across borders and whatnot, which are pretty cool and awesome, right? But it's not a currency. And so, if and when crypto becomes a true competitor to the US dollar, our government will ban crypto just like China did. That's my belief.
Interesting.
Yeah.
Because what fascinated me is so much of the currency today isn't print. It's not printed. It's not tangible.
Yeah, it's already digital anyway, right?
It's already digital. Yeah. So I find it interesting that in order to go digital, they feel that they have to go this extra mile, when in my opinion, most of the dollars aren't printed anyway. The trillions of dollars that are out there are actually in ones and zeros. And so I find it interesting they're going this route. And one of the things that happened with regards to the sanctions that the U.S. government does internationally against certain regimes and governments has been locking, freezing banks. And we're already seeing that capability at a government level. And then they take it down to individuals, oligarchs, and so forth, and they do it at a personal level. And now we're starting to see it kind of enter itself into more of the mainstream, if you will, as they start impacting individuals. So I find this whole topic quite fascinating, simply because of the fact that it is currency and it's the exchange and how we interact with one another. But this move from the dollar to the CBDC is going to be, I think, interesting. How they distinguish between the two. Is it a 1-to-1 ratio? Does it matter? Do I have to have one or the other? Do I need both? Will I eventually need to move only to the other? Because I've started with my Google Wallet on my phone, using it instead of the card. So I've got that Bluetooth ability currently, but I'm doing it in dollars via the credit card that I have. So, what's going to be different about what this might be, and how would that look? So I'm quite interested in all that. All right, here's my last question for you. Cello. Do you do much with the cello anymore? Do you practice? I know that you say you go to the park there and do it and so forth. What are you doing there?
To be honest, I haven't pursued it as much as I would like. I love playing the cello, but it's hard as an amateur. I guess it's like, imagine if you played Division I NCAA basketball and you didn't go NBA, and now you're playing, you have the option to play pickup games in your local park or something, right? It might leave something to be desired, right? So I haven't found a group that I can play with where I'll feel like I'll be challenged and enjoy myself. But that's because I haven't really tried. And the pandemic really screwed up classical music because so many people are older. And so just a lot of people stopped.
Yeah.
But now that is over, I do have plans to play chamber music. I love string quartets. I love piano trios. I want to find a group here in Phoenix that I can play with and do more of it.
Are you familiar with a group called the Piano Guys?
Oh, yeah. I love them. And I love two cellos. Have you ever seen two cellos?
Yes, I have.
Yes.
There you go. All right.
I used to have some friends who ran a fiddle camp. And I went a couple of years, and I learned how to play bluegrass and Scottish music and just a lot of folk music on my cello. Yeah. So I like to jam and play by ear.
Okay. That's a little jazzy too.
Yeah, it can be. Yeah. So But you know how it is. Like when you're starting a business and you are running a startup, it's like you have time for maybe that and your family. It's really hard to find time for hobbies.
I'm 100% there. Yeah, it's very demanding, and you're mentally in that space all the time. So yeah.
My dream is hit it big with one of these startups that I was a part of, or the one that I'm building now, and be able to retire early and get involved with like my local orchestra on the board. Because I feel like a lot of these classical music organizations are not managed properly on a financial side of things. And I could really help as a CPA, with the endowments and the finances, and just, keep them from going under. Because it seemed like when I was a cellist, they were always having financial problems.
Blake, you need to do it. That would be an excellent application of your skills.
Thank you. We'll check in 10 years and see where I'm at.
There you go. No, that would be wonderful. Well, here's what I'm going to do. I'm going to wrap this up simply because we've gone longer than normal, but I felt this was a wonderful opportunity to discuss some very pertinent things, and I appreciated the insights. Yeah. So here's what I'm going to do. I'm going to basically go over an offer, summarize our conversation, and then come back to you for a closing thought. So as I do this, let me just point out, as an offer, Blake is very kind to put in the episode descriptions information you need regarding his Earmark platform and how you can actually go there and download the app and take advantage of listening to these CPE-related interviews and so forth. So take advantage of that platform as a CPA, as an EA, to go out there and get your CPE credits. It's a phenomenal platform that you need to take advantage of, and I encourage you to go to the episode description to find more information about how exactly you can do that. In addition, there are some additional free resources there that you'll want to take advantage of. If you haven't checked out the episode description, do so, because you're going to find tools, resources that you can actually apply in your business to help you as a business owner, as a business leader, and as well interacting with your clients in an accounting perspective. So check out those free resources. As a summary of our conversation, I have to basically say that it was very delightful to hear Blake share his story. I wasn't aware of the fact that accounting wasn't his pursuit. I knew of the cello, but to learn that was his first inclination and was going down that route, and then tangentially got involved with bookkeeping, started the bookkeeping just as a way of kind of paying the bills, but lo and behold, over time, built a successful bookkeeping business. In that process, he ultimately became a CPA, but literally sold that firm into another, merged that, and was very successful in that transition. But in that light, got involved in the tech space and really became quite insightful in those two different worlds so as to communicate a lot of the expertise there. We had a great conversation about not just accounting, but really what accounting is today, as especially it applies to the subscription model, and how we as accounting professionals need to become more and more familiar with it, especially as it applies to our clients. Not only are these principles ones that we can use in our own business model, but literally we need to be able to, with the language of accounting being business, we need to actually now take that information as it applies to subscription and really articulate what's going on with lifetime values, cost per acquisition, and so forth, and really kind of focus on those KPIs that are outside of the traditional accounting model. So the language of business really is accounting, but we've got to realize that there's a lot more to discuss there. The other thing that I really appreciated was his insights regarding just business in general. He has some great ideas as it relates to growing the business as a CPA, finding time, making time to grow the company, really putting that as a priority, and some suggestions there. So Blake, thank you for those insights, for those topics. What would you like to leave as a final thought?
Oh, I guess I just want to say that as much as I like to criticize accounting and the profession, I love this profession. I love accounting. There's so much opportunity to build sustainable, profitable, exciting businesses. And I hope that more listeners take that leap and start firms and do things differently, because this opportunity is enormous.
Excellent. Wonderful closing thought. I likewise want to kind of just basically share my love for this profession as well. I've been doing this for 30 years, working with accounting owners for 20 years, 25 nearly now, and it's just been very rewarding. We make such a difference in the economy, and we can make such a difference in individual businesses. So definitely embrace it and become a part of it, make a difference. All right. So with all that being said, Blake, thank you for being on the show. For my listeners, if you haven't already, definitely subscribe to the podcast. We want you to go ahead and like it, notify yourself of the different releases that we do each and every week. If you haven't gone back and binge listened to previous episodes, do so. We've got a variety of topics. Over 200 episodes have been released, and you can have access to each of those. So check out the highlights by going to universalaccounting.com. We've got basically some playlists there that you can take advantage of, where we've collected a few of the different popular things, and you can see what those are. In addition to subscribing to the podcast, I want to invite you to GrowCon. It is an annual event for owners of bookkeeping, accounting, and tax businesses. It's the event that you want to attend as the owner of the business, as we bring to the stage the experts, those individuals that have those things that we need to be working on in our business, so that we can hear from them and apply them in our companies. We also want you to visit with your peers, make connections, find out what others are doing that are successful, and make those connections that are helpful in helping you grow your business. And then lastly, visit with Universal Accounting. It's here you can meet the team and see those individuals that are committed to helping you build your business, work on your business, and do it successfully, so that you're in business for yourself, but not by yourself with Universal. The other thing I'd like to point out is, if you'd like to apply these principles and others that you've heard of, feel free to check us out by going to universalaccountingschool.com or calling us at 801-265-3777. And always remember this: if it's about accounting, it is Universal. Take care and have a great day.